Most of the time, we live our lives without thinking about the forces quietly shaping every financial decision we make. The price of a home, the cost of a car, the rise and fall of the stock market. These things feel mysterious, unpredictable, almost random. But behind all of them, there is one silent driver, a single percentage that changes the rhythm of the entire economy. We call it the interest rate. And even though it sounds like a technical concept, it affects more of your life than you might ever realize. Today, we're going to slow things down, peel back the layers, and understand how interest rates truly work. Not with complicated formulas, but with simple logic, clear reasoning, and a deeper look at the world around us. Because once you understand interest rates, you begin to understand the hidden story behind money itself. Imagine you borrow $100 today, and a year later, you owe $105. Most people look at that extra $5 and think, yeah, that's the cost of borrowing. But the real question is much deeper. Who decides that number? Why is it $5 and not 3 or 10? And why does that small number have the power to shake stock markets, change housing prices, and even influence whether companies survive or disappear? To understand interest rates, you have to forget everything technical for a moment. Just think of time. Because interest rates at their core are the price of time. When you borrow money, you aren't just taking someone's dollars. You're borrowing their future. You're using time that isn't yours yet. And time, at least in the financial world, has a cost. A simple way to think about it, imagine you want to drive a car that you can't afford yet. Someone lends you theirs for a year. When you return it, they want something in exchange. Not because they're greedy, but because during that year, they couldn't use their own car. They gave up time. That compensation is interest. Not a punishment, not a tax, but simply the price of having something before you actually earn it. But, of course, in the real world, money comes from banks. And banks themselves get their money from somewhere else, too. That somewhere else is where things start to get interesting. Because banks don't just pull interest numbers out of thin air. They react to a much bigger player. The Federal Reserve. The Federal Reserve, or the Fed, is often spoken about like it's some mysterious, powerful institution. And in some ways it is. But in reality, the Fed is simply the bank for all the banks. It sets the rules of the financial environment. And the most important rule it controls is the base interest rate known as the federal funds rate. This is the rate banks use when they lend money to each other overnight. It sounds small, right? Banks lending money to each other for just one night. But this tiny number is like the root of a tree. Everything else grows out of it. When this rate changes, the entire financial system adjusts. Mortgages, car loans, business loans, credit cards, government bonds, stock valuations. Everything ripples outward from that single point. But the Fed doesn't change interest rates just because it feels like it. It reacts to the temperature of the economy. When the economy gets too hot, when prices are rising too fast, and money is moving too quickly, the Fed raises rates to cool things down. Higher rates make borrowing more expensive. Businesses slow down expansion, consumers buy less, and prices stop spiraling upward. On the other hand, when the economy is weak, when people are losing jobs, when businesses hesitate to grow, when spending slows, the Fed cuts rates. Lower rates make borrowing cheaper. Companies invest again, people buy homes and cars, and money begins circulating more freely. In other words, the interest rate is the thermostat of the economy. Too hot, turn it down. Too cold, turn it up. It's a simple idea, but the consequences are enormous. Let's zoom in on what rising interest rates actually mean for ordinary people. Imagine you want to buy a house. At a 3% mortgage rate, the monthly payments look manageable. But if rates jump to 6% suddenly, the same house becomes dramatically more expensive. Not because the house changed, but because the cost of borrowing doubled. Many people simply can't afford the same loan anymore. For businesses, it's the same story. A company wants to build a new factory or open a new store. At low interest rates, borrowing is cheap and expansion feels safe. But when rates rise, the cost of financing increases. That new factory might now be too expensive to justify. Expansion slows. Hiring slows. Growth slows. And eventually, the entire economy responds. This is why interest rates dominate financial news. Because when the Fed adjusts its rate, it's not just about banks. It's about every big and small decision in the economy. The higher the rate, the heavier everything feels. Now let's look at financial markets, because interest rates shape them in surprisingly powerful ways. Take the stock market. When interest rates rise, borrowing becomes more expensive for companies. Their profits shrink. And because investors value future profits, those future earnings become worth less in today's dollars. So stock prices fall. Not because companies suddenly became bad, but because their future became more expensive to reach. Then there are bonds. If you buy a bond that pays 3% interest and suddenly new bonds come out paying 5%, who wants your 3% bond anymore? Almost no one. Its price drops. And that's why bond markets move inversely to interest rates. When interest rates rise, bond prices fall. When rates drop, bond prices recover. Real estate follows the same pattern. Higher interest rates mean fewer people can afford mortgages. Fewer buyers means less demand. And less demand means prices cool or even fall. Gold behaves differently. Gold doesn't pay interest. It just sits there. So when interest rates go up, gold seems less attractive. Why hold gold if you can earn more money safely in a bank? But when people fear inflation, recession, or instability, gold becomes a safe place to hide. So gold rises when confidence falls. All of these reactions, stocks, bonds, real estate, gold, aren't just financial mechanics. They are emotional mechanics. Investors don't simply respond to numbers. They respond to fear, optimism, uncertainty, and hope. So sometimes the market falls on the mere whisper that interest rates might rise. Not because anything has changed yet, but because people are afraid of what might happen. This brings us to perhaps the most overlooked truth about interest rates. They don't just change the economy. They change how people feel about the economy. And how people feel drives behavior. If consumers believe rates will rise, they rush to borrow now. If businesses fear recession, they slow down hiring. If investors suspect trouble, they sell before trouble actually arrives. In that sense, interest rates are not just a financial tool. They are a psychological tool. A way to influence human behavior at scale. So let's step back and look at the big picture one more time. Interest rates are the price of time. They are shaped by the Fed, influenced by inflation, and felt by every borrower, saver, investor, and business. They affect the cost of homes, the growth of companies, the value of money, and the direction of financial markets. They are the heartbeat of the economy, a single number that quietly determines how fast or slow money flows through our lives. But perhaps the most surprising thing is this interest rates often move not because of what the economy is today, but because of what people fear it might become tomorrow. In a way, an interest rate is not just a financial signal. It's a message. A message about confidence, stability, growth, and risk. A message that tells you whether the economy is calm or whether it's heating up. Whether things are safe or whether caution is needed. So the next time you hear that the Fed is raising interest rates, or lowering them, or simply considering a change, remember this: it's not just a number. It's the story of the entire economy being told in a single percentage point. A story that touches your loans, your savings, your investments, your job prospects, and your financial future. Interest rates may look small, but they carry the weight of the entire economic world. And once you understand that, you begin to see why even a tiny move, 0.25%, 0.5%, can send shockwaves through markets, shift fortunes, and change the path of millions of lives. Because in the end, interest rates are not really about banks or markets. They are about us, about the choices we make, the fears we carry, and the future we hope to build. If there's one thing to take away from all of this, it's that interest rates are more than a financial statistic. They are a signal, a quiet message that tells us what the economy needs, what people expect, and how the future might unfold. They influence how we borrow, how we spend, how businesses grow, and how markets behave. And even though the number seems small, its impact touches every part of our lives. The next time you hear the Federal Reserve announce a rate change, you'll know what it really means. You'll understand the ripple effect that moves through homes, companies, banks, and markets. And you'll see that behind every percentage point is a story about confidence, caution growth, and the constant balance that keeps the economy alive. Thanks for spending this time diving deeper. And as always, the more clearly we understand the world, the better decisions we can make within it.